If you're retiring with a RRIF, a registered retirement income fund, how you choose to draw down the account can have a massive difference in how much tax you pay. So in this video, I want to walk you through a recent Globe and Mail article that covers 10 RRIF strategies and share my take on each one. Because some of these strategies go against the planning strategies I discuss on this channel and could end up costing you a lot more in taxes throughout your retirement. So this article was in the Globe and Mail a few weeks ago, and I just want to cover off. So delay RRIF withdrawals this year. Now again, the Liberals promise a reduce of 25% of the minimum RRIF. Now at the end of the day, yes, you could reduce, if they actually follow through with this, you could reduce the minimum amount by 25%, but this would only qualify for a very small fraction of the population, and those are people that have converted their RSP to a RRIF and ended up going back to work this year and have an income and don't need any RRIF income, but there's that minimum amount that you have to take out. Again, not many of you fall into this category. If you're someone that's retired, you didn't go back to work, you're just planning on taking out money out of your RRIF, typically for 99% of you watching this video, taking more than the minimum amount is going to be the best plan for you. So the fact that you can reduce the minimum amount shouldn't affect hardly any of you. So don't fall into this trap. Again, if you've gone back to work and all of a sudden you have a big income, you don't need that RRIF income and you have to take it, well, the reduction will help. That's probably 0.01% of you watching this video. For the rest of you, you should be taking out more than the minimum anyway to have a proper tax and cash flow plan. Now, before I jump into number 2, I do want to make a point here. The title of this is Consider These Top 10 RRIF Strategies to Save Taxes This Year. And so many of you are looking past that this year. And this article is written by a CPA I've followed for years, love his stuff, does great work. But I think one nuance here we got to pay attention to, and this is where the article is written around, is taxes for this year. And so again, everyone's situation's a little bit different, but there's a difference between taxes this year for retirement and taxes for the rest of your life for retirement. And if you only focus on this year or a very short period of time, you're probably not doing yourself a great service. So while this article has a lot of great points, I think we all have to be careful when we read stuff like this that is he talking about this year? Is he talking about forever? So be aware of how you read this, because yes, there's some great points for this year, but they could hurt you in future years, which I'll cover here going forward. The second one is take advantage of the pension credit. So once you're 65 or older, your RRIF withdrawals will qualify you for the 2000 pension credit. So consider converting a portion of your RSP to RRIF before 71, even if you don't need it, to withdraw the $2,000. So just a reminder here, this is a pension credit on the first $2,000 of income. So when you pull the first $2,000 out of your RRIF, it qualifies for pension income past age 65. And that gives you a non-refundable tax credit of roughly 15%, so $300. So it's something all you should be doing, but be aware, it's not a $2,000 benefit. It's a roughly $300 benefit, which is still a benefit and all you should be doing it. But just again, be careful how you read that. And again, we've had some comments on our videos before too, of people thinking it's a $2,000 tax benefit. It's not. It's a tax credit on the $2,000 of income at 15%, giving you that $300 total tax benefit on your tax return. The third one is make withdrawals annually, not monthly. So if you don't need your RRIF money every month, which would be, again, a small number of you, consider delaying it. And he goes, this allows dollars in your plan to continue to grow throughout the year. Well, this obviously assumes that the markets are growing as well. But I think for the majority of you, your RRIF income is going to be a large, if not the largest piece of your retirement income. Now, for some of you, yes, it might be a small account. You might have a big pension plan. Your RRIF is a very small amount that you might take a couple $1,000s out every year. Yeah, you could do that on an annual basis. But for the majority of you, your RRIF income is a monthly income, the largest amount of income you'll receive, and you need it weekly, bi-weekly, monthly. So saving it annually probably isn't a good option for most of you. Plus, this implies that markets are going up. Well, what happens if markets go down throughout the year? And that's why, unless it's a small amount, dollar cost averaging out might make the most sense for you, takes out the stress, and typically aligns with how you were paid before you retired, which as you walk into retirement, you want to keep things simple and kind of keep that flow going. So if you were paid every 2 weeks, I would set up your RRIF withdrawal in that same fashion. The next tip is to draw down non-registered assets first. So if you're drawing on your investments to meet cash needs in retirement, consider withdrawing from the non-registered accounts. This can give rise to capital gains, which are taxed at lower rates than RRIF withdrawals. So again, this is going back to planning for this year. Yes, taking money out of your non-registered accounts could allow you to pay less tax this year, but you're delaying a compounding tax issue. And again, I've done thousands of scenarios, and I've shared many of them on this channel. And yes, your non-registered account is typically more of a lever account. So drive everything from your registered accounts, do tax planning around that. Your non-registered account is more of a lever account. If you need a little bit more money, pull it from there. If you don't, leave it in there. Use your non-reg to top up your TFSA as well. So there's some strategies there, but I would not say draw down non-registered assets first. In fact, I would say, again, going back, that's probably the 1 or 2% of the population where it makes sense. And that's typically, we see, when you have a very large non-registered and potentially very large registered accounts. You don't need it all. There's some movement there. You have some large capital gains. Again, it's a very small fraction of the population. For most of you, you should not be taking money out of your non-registered first. That's a very bad plan for the majority of you watching this video. Again, map it out with your financial planner to see what the best solution is for you. But just the concept of taking your non-registered assets first because capital gains tax is lower than your RRIF income, while that statement's true, overall planning by doing this, not gonna work well for you. The next one is to base withdrawals on the younger spouse. So when you set up your RRIF, you can specify whether you use your own age or your spouse if they're younger than you, which is absolutely true. You can do that. It could be beneficial, again, to a small percentage. But going back and looking at a proper drawdown strategy in retirement, you typically want to be drawing out more than the minimum amount. Now, there's no harm in putting your younger spouse. If you're taking out more than the minimum, well, you could put your younger spouse anyway. I always say, do whatever you want. I would say that it's 0.5% of the population and plans we do, this would be beneficial, probably much less than that actually. So this is probably a non-factor for the majority of you. But at the end of the day, if you have a younger spouse, there's no harm putting your minimum RRIF amount based on their age. It'll allow you to take less amount out if you all of a sudden go back to work, right? Going back to number one tip, which was a 25% reduction. If you go back to work and you want to take less out, well, you can fall back on your younger spouse's age. So no harm in that. If you haven't set it up that way, don't worry about it. If you've set it up based on your age, which is what 99% of the population does, and there's no harm in that for most of you. So don't stress on this one. If you still have to convert to a RRIF and you want to use a younger spouse, absolutely do that, but typically not a big factor here. The next one is to take advantage of pension splitting. This is a no-brainer. Money that comes out of your RRIF can be split with your spouse or common law partner. Now, one key tip here, and they say here, you and your spouse can elect to report up to 1/2 of your RRIF withdrawals on your spouse's tax return once you are age 65 or older. So this could save tax as a couple. Now, where it says age 65 or older, one nuance here that you need to be really aware of that could help you out is it's not based on the day you turn 65. So let's say you turn 65 halfway through the year, any RRIF income that you've drawn in the first half of that year, it can still be split for tax purposes. So it's the year you turn 65, not the day you turn 65. So you might be thinking, well, good thing because my birthday's in December and I would have lost almost a whole year. Not true. If you took $50,000 out of your RRIF that year and you turned 65 only in December, but all that money came out before your birthday, that can be split with your common law or spouse. So don't worry about that. It's the year you turn 65, not the day you turn 65. So consider that when you do your tax planning, right? You don't have to wait halfway through the year. In fact, we had a client that we took on, they're like, no, we're waiting till they turn 65 so that we can split that income. Not the way it works. It's the year you turn 65, you're able to split that income, any RRIF income that you took out throughout that whole calendar year. The next one is to keep the 4% rule in mind. To me, if you're still running the 4% rule, you missed the boat. That's long gone for the majority of you. If you're running a 4% rate or 4% withdrawal in your retirement, you probably don't have a great tax plan. And if you do, it's just an absolute fluke. So I would say keep away from the 4% rule. You can see in the drawdown strategy I've done in other videos just recently, clients are taking typically 7 to 10% early on in retirement out of their registered accounts. So if you're only taking 4%, you're probably not enjoying your go-go years. You probably don't have a good tax plan, and you're probably going to die with a lot of money in your RRIF account. So again, reconsider the 4% rule. I don't think it's a good one. Very rarely does it work. Typically, you have to take out more than that if you want a proper cash flow and tax plan in your retirement. The next one is to consider RRIF withdrawals to make TFSA contributions. So if you're going to face a very high tax rate on your RRIF upon death, which a lot of you are because you're not doing proper planning, it could make sense to withdraw from your RRIF earlier in those withdrawals to pay a lower tax amount. And this is often the case in the plans that we build. Again, we want tax plan. I always tell clients, we're taking more out of your RRIF, not because you need the income, but because it's for tax planning. And we're going to take that extra money and top up your TFSA. And yes, we're paying some tax now, but we're allowing that asset to grow tax-free moving forward, and we've leveled out your tax bill. So for a lot of you, this is going to be a strategy you should be employing. Take more out of your RRIF than you need because it's a good tax plan. Don't go spend that money. You're going to need it in the future. We're just moving it to the TFSA account to create flexibility around your taxes and cash flow planning down the road in your retirement. The next one is to name your spouse as a successor annuitant. And this is obviously a great tip. Rather than naming your spouse as a beneficiary of your RRIF, you can name him or her as a successor annuitant. In this case, the RRIF continues to exist after your death. Your spouse will become the annuitant. This is much simpler administratively for your surviving spouse. And this is true. You can absolutely have the surviving, then the account stays as is. Eventually, they want to amalgamate them together typically anyway. If you have a beneficiary on the RRIF, that works out too. All that means is that when they pass away, there's a bit more administrative upfront, but it rolls into your RRIF as a spouse or common law partner. Either way, have a beneficiary, have a successor, just have something. Make sure you have listed someone as your beneficiary or successor. That's what's going to save the headache. Again, successor, much like a TFSA, make sure you have a successor, much more important there. But again, you can name a successor or beneficiary on your RRIF account to make sure that that money rolls tax efficiently to the person that it should. And the last one is keep in mind your tax-free level of income. So if you're 65 or older, you can generally earn about $24,000 of taxable income annually before you pay any taxes. And obviously this is true as well, and this is a great thing to know. But one other caveat to this is we live in a progressive tax system, meaning that, yeah, the first $24,000 is essentially tax-free at 65 or older. But then you start paying a small amount of tax. And the more you make, the higher percentage of tax you're going to pay, percentage-wise. So a lot of you, what you're doing is you're staying under that $24,000 as long as you can. And then all of a sudden, you still have a lot of assets to draw out, and you balloon into a very high tax bracket. What's typically better is to find that threshold where, yeah, you're paying a little bit of tax, but it's avoiding a very high amount of tax later on. And this is where you want to level out your average or effective tax rate through your retirement. If you're creating many years of zero tax rate, you're typically just bumping that issue down the road. And when you bump it down the road, you're bumping it into a progressive tax system, and you're going to pay a lot more tax on that income potentially. So again, sit down with your financial planner and see what the best plan is for you. But yes, the first $24,000 is tax-free. But for a lot of you, you need more than that to survive here in Canada. It's very expensive to live. And typically you want to be leveling out that income over years versus low years and high years. And then to tie into that, of course, if these low years are in your go-go years, are you wasting good years of retirement when that money's sitting there? Go spend your money, enjoy retirement. Don't wait for tomorrow because it may not be here. So hopefully this helped out. Again, a great article, great tips. A lot of these tips for taxes this year. And when you look at retirement planning, you typically want to look at this year, but much beyond this year as well. How does everything come together? So be very aware of how you do planning, what you read online, even though it's great information. Be aware how it applies to the current date. Does it apply to you today, future? How does it integrate into your plan? All that's very important. So hopefully this helped out. Hopefully it broke it down a little bit better for you. And we'll see you in the next video.